Apple stock is going down. This is the investor. Welcome to my channel. Grab a cup of coffee and join me and my pub because today I'm about to rest my case why Apple stock is about to go down in 3 simple steps. In step number 1, we'll examine some trends that should have an impact on Apple business. In step number 2, we'll check the valuation and see why the stock is overpriced. And in step number 3, we'll analyze the technical megastorm that is forming in Apple chart. So buckle up. Disclaimer, as always, this is not a financial advice. Do not listen to YouTubers and make your own decisions. And now we can proceed. Apple measures their business in 6 segments: the iPhone segment, Mac segment, iPad segment, home accessories and wearables when you can find Apple TV and Apple Watch, and services when they sell Apple Care and some digital content. If we take a closer look at the revenue split, we can see that the iPhone revenue is about 60% of all revenues. Why is it important? We'll see in a moment. If we check the revenue, we can see a steady growth, which is excellent. But let's look at the more important metrics, which is iPhone shipments in millions. We can see after a huge spike in 2015, a drop in 2016, and then the number of units shipped entered some sort of a plateau. We can see some recovery by 2020, which we can relate to the rebound in the economy after the lockdowns that we experienced during 2020. And we can see the number of units shipped between Q4 and 2019 and Q4 2020. But we should ask ourselves, did this rebound exhausted itself, or does the number of shipments can increase and fuel Apple's growth even more? Let's look at another important factor. Because of the lockdowns and people staying at home, demand for personal computers, Macs, iPad, iPhones increased, and actually in 2020 the number of PCs and accessories that were shipped were up 13.4%. Of course, Apple enjoyed that, but at the same time logistic chains were disrupted, factories were shutting down, even car manufacturers halt productions. All of this led to microchip shortage, a huge microchip shortage. Well, you ask yourself, how can this affect Apple business? Well, let's check Apple suppliers. They have Lumentum, Skyworks, TSMC, Qualcomm, Broadcom, Cuerva, Jabil, and many more microchip suppliers that supply parts for the iPhone, iPads, and Macs. And if they're experiencing higher costs, of course they will roll it over to Apple, who will have no choice but to increase their iPhone prices. If we summarize the business perspective, we can see that iPhone sales are in a plateau, and we can see that microchips prices are about to go up. This will affect Apple, who will have no choice but to increase their iPhone prices. Also, the US-China trade wars are a threat to Apple. We can see that in the last quarter of 2020, Apple grew its sales in China very much compared to Q4 of 2019. But if another trade war begins, that might affect them. Yesterday, President Biden, during a speech about America's withdrawal from Afghanistan, referred to China and said that the United States need to recalibrate its foreign policy to face bigger challenges like China. All of this will affect US-China trade relations, and of course this will affect Apple in time. So we saw that from the business perspective, iPhone sales numbers are stuck, and Apple is facing a choice whether to increase iPhone prices or reduce margins. By the way, guys, if you like the content so far, please subscribe to the channel and support its growth. Thank you so much. Now let's look at the valuation and see why Apple's stock price is overvalued. We will not use a dividend discount model because the Apple dividend is not so generous, but we will use a price to earning future growth model and a discounted cash flow model. Starting with the price to earning valuation, we can see the Apple PE in the past 2 years simply exploded, doubling the normal numbers of a median of 14.6 and an average of 19.6. Checking the earning per share, we can see it's growing nicely over the years, and if we take everything into the model, we will use a growth rate for the upcoming 3 years of 12% and then later on reduce it to 10 and 5% in 10 years from now. The required rate of return is 7.5% and the expected PE is 17, which is about 3 units more than the median of 14.6. Taking analyst estimates into account when regarding to earning per share for 2021 and 2022, and we come up with a fair value of 18.5. Let's try even something a little bit more riskier and use an expected PE of 20. In that case, we will come up with a fair value of 94.7, still 30 to 35% below the current price of Apple. Let's try the discounted cash flow models. We can see the future cash flows based on analyst estimations for revenue. To derive the cash flow, I use the median value of the free cash flow to revenue of 0.26, which is based on Apple's past performance, which are very stable. If we take everything into the model and use a weighted average of capital cost of 8.9, perpetual growth of 2.5, divide the terminal value by the number of shares standing, we come up with a value of almost $84. When recording this video, the current price is $132, and we can see both models give us about 50 to 45% decrease from the current price. So this doesn't look so good for Apple's stock price. So we covered the valuation perspective and saw that Apple's stock is overpriced. Now let's check the technical megastorm that is forming in Apple's graph. But first, a short reminder on Elliot wave theory that suggests that stock prices trend due to investors' predominant psychology, and that prices form their trends with an impulse wave followed by a corrective wave. As we can see in this drawing, we can see the bigger trend from here to here as an impulse wave, and then the correction coming from this point to point C. As we can see, each move is defined by 3 upgoing waves and 2 going down waves. We can see 1, this is an up wave, 2 down wave, 3 up wave, 3 down wave, and 5 up wave, followed by a corrective stage which is formed like A, B, C. Let's apply all this data to Apple's chart. Starting after the dot-com crash, and we can see an impulse wave, a very long impulse wave starting in 2003 until today. 1, 2, 3, 4, 5, meeting all of Elliot's waves rules. Taking a look at the last part, okay, from 2013. Let's check it out and see another impulse wave over here. 1, 2, 3, 4, which is still higher than 1, and then 5. Okay, not enough? Let's look at even shorter time frame for the last section from 4 to 5, and we can divide this one also to an impulse wave starting with 1, 2, 3, 4, which is above 1, and then 5. And we are here in the final stage of the Elliot wave megacycle that started to form up from 2003. What can we expect from that? Taking a look at the Fibonacci retracement for the move that started in 2003, we can see that it can expect a correction of about, I would say 60 to 38% based on the Fibonacci rules, and this will lead us to a price between 55 and 90. If we just take a look at the shorter time frame and see what correction can we expect there, we can see that the correction level based on the Fibonacci levels is somewhere between $98 and $73. This is a huge decline in Apple's stock price. Let's move to conclusions. If you made it so far, you must have found some value in this video, so please subscribe for more. Apple is a great company, but it faces some headwinds due to iPhone unit sales stagnations, microchip shortage that will drive prices up and reduce margins, and also uncertainty in US-China relations. The stock is overpriced based even upon the optimistic party among analysts. And based on Elliot wave theory, a mega correction of stock price is coming and waiting just behind the corner. So Apple is falling, and I'm ready with cash to meet the price around $80 to $19, which is 30 to 40% down. Until next time, do not listen to YouTubers, comment below and say ciao to my puppy. Bye!